All right, everybody, welcome back to another video. I'm so excited for this one because this has been a heavily requested topic on my channel to go a little bit deeper. And today we're talking risk management, and I'm literally going to give you this presentation that took me about 30 minutes to prepare. I felt like I was back in high school preparing a presentation, so I hope you do enjoy it. If you do me a favor, please give this video a thumbs up down below. It does help to share this video with more people and hopefully recommend you to watch videos like this more in the future. YouTube is pretty smart like that. So let's jump into today's topic, which is talking about risk management. And this topic, I wish it got more covered in mainstream trading content out there on the internet, because this is the sort of stuff, like it said on the front page, it is literally a trader's secret weapon, in my opinion. This is the do or die topic for so many traders that so many traders are lacking. So what I'm going to do, I'm going to invite you to real quick take a mental note, watch this video all the way until the end, because I've put together some tips here that I really think could potentially help a lot of traders who are struggling to actually find profitability. So stay tuned. Let's get into this. So why is risk management so important in the first place? This topic, literally, you will not survive in trading without this topic understood pretty well. Not just like, oh yeah, I know you shouldn't take too big of it. I'm talking actually understanding this concept will really drastically make a difference. This was the barrier for me from becoming a profitable trader and not becoming one. This topic of understanding the math, the basic math, really, the concepts here that will make you so much more less susceptible to ginormous drawdowns, ginormous blown accounts. We don't want any of that here. So today we're learning about how to know when to hold them, know when to fold them. You may have heard this expression. I'm currently learning how to play poker, so this is very fresh in my mind, but it's very, very important to know how to hold on to good trades and drop off and stop the losing trades from hurting your account, which is hopefully what we talk about today. Drawdown and losing streaks are inevitable, so we need to talk about how we can actually survive them. Again, very, very important, because so many traders work themselves up over the fact that they actually can take winning trades just fine. It's the losing trades that destroy them. So if that's you and you're struggling, again, let's stay tuned because we're going to get to that. So what does it actually mean for us to manage our risk? You could see the lady on the right here. She's pretty panicked. And I'm sure that if you have not been managing your risk, then you might look just like her. Actually, she's rather pretty though. So let's not, you probably look worse than that. Let's be honest. So we've heard the term, but what does it actually mean to manage risk? And for those of you guys who are prettier than her, by all means, happy for you. But we're just talking most people, let's be honest. When we're not managing our risk, we do not look that good. So we want to minimize the potential losses we could incur and maximize the potential gains. That sounds so simple, but I'm going to read it again because of how actually important that topic right there is. That's like golden words. If I could put it on a silver platter, I would. We're trying to minimize the potential losses that our account could incur while maximizing the potential gains that that same account could incur. We want to be making those gains count and getting rid of losing trades. How do we stop ourselves from getting in those terrible losing positions where we just have no idea what to do? That's where risk management comes into play. Have you ever held on to a losing trade with no plan? Because I can almost guarantee that if you have, you remember it just like me. There's been times where I've been stuck in this situation, and that is no fun, right? We don't want to be in that situation of, I don't know what to do with this trade. I have no plan, and it's just becoming a giant problem for me. We don't want to be in that situation. Again, we want to look like this lady on the right who looks great, even though she looks a little bit panicked as well. We want to be looking like that or better, hopefully. So risk management method number one. We're going to be talking about using a stop loss. This is a very simple concept. I know you guys know what stop losses are, or at least I hope you do. It's a very basic concept. We already know that it stops us out from losing trades. And a stop loss is a debate in its own, because some people say you should use them, some people say you should not. But today we're talking about the pros mostly of using a stop loss and how we can actually use it to potentially manage our risk more effectively. A stop loss allows us to set our risk by closing out positions if the trade goes against us. That should say against us. The idea here is that if price doesn't go our way, a stop loss helps us get right out of that position. Remember, we talked about, we wanted to go back. Let's go back to this slide. Remember that second point that I kept talking about on a silver, or was it gold platter? Minimize potential losses and maximize potential gains. We go back to this concept. A stop loss allows us to risk less by closing out positions if they go against us. That's pretty much close to our definition that we just talked about. We want to minimize losing trades. So this helps us to stop out of losing trades. Now, if we take a buy position and the market moves lower, right? It's not going the way we had hoped. You can see in the picture down in the bottom right. Let's say we bought that market thinking that the continuation was next, and we were wrong about it. Well, look at how that stop loss limited our downside risk, because look what happened after. It kept going lower, and I think it just kept going off the screen. I just ran out of screenshot material. It just kept going down and down and down, right? That was an ugly thing if you held on to that trade. So a stop loss in this case actually really helped us because it stopped out that trade from getting any worse. So it said, okay, we took a buy trade and it didn't work out this time. Again, going back to our very first slide, no strategy or approach is always going to get you into the right trade. It's nice to think about. Sometimes I have dreams about it, but the end result is, for the most part, it's not realistic to take winning trades 100% of the time. The idea is that we are going to take losses, so what are we going to do about them? Well, this stop loss method basically allows us to get out of those losing trades by putting them in intelligent places. We can talk more about that in a moment. But going off of that, but where do we put a stop loss? And what is it so that it is less likely to be hit? Where do we put that stop loss so it's not as likely to get hit? This is where our other things that we talk about on the channel. We're not going to get too far into this topic today. We do have some videos on the channel for placing stop losses, but the basic idea is we're going to use all the other lessons of price action and technical analysis and fundamental analysis to try and guide or place a more intelligent stop loss using things like market structure, price action, etc. So I definitely encourage you to go check that out if you're struggling with where to put your stop loss. A lot of times it's keeping it simple for me that works, is putting it under structure, putting it in reasonable places so that, if support holds and I'm long, I don't want to get stopped out preemptively, but I also don't want to put a stop loss that is too far away either. So definitely check out some of the content on the channel for that. But how much should, this is the other part of the risk management side, the understanding of it, how much should a person risk on a stop loss? So we have a stop loss, and that means that's one part of the game, but how much do we actually risk with that stop loss? Do we risk 20% of the account? Do we risk 10% of the account, 100% of the account? What do we do with it, right? And that's where it's going to be very, very important to understand these concepts of risk management, because again, so many traders get this wrong because they risk giant amounts of their account on every single trade. Even if they have a stop loss, it doesn't matter because they're risking so much of their account. So we need to know the percentage matters most. Okay, the percentage is what matters here. So many traders are, so caught up in I'm just going to risk $100. But if your account is only $200, 2 trades knocks you out of the game. So let's step back, let's break this down, and let's talk about how much risk per stop loss. Again, percentage is what matters. How much, you have to ask yourself, because everybody's risk tolerance is a little bit different. How much percent of your account, how many percent, how much percent? I'm not sure exactly the right English there, but how much of your account are you comfortable risking if a trade goes against you? This is the question every trader has to ask themselves. How risky are you in your trading? Let me tell you that I personally stick to 0.5% to 3% risk per trade. Okay, and that's with some of my momentum-based strategies. That's usually what I'm doing. So I'm risking 1-2% of the account to try and see what I can make out of it. I'm not risking 20%. I'm not risking 50%. You see a lot of beginner traders making this mistake where they risk a ton of the account on every single trade. So if I had $1,000 in an account, what this means is that if I'm risking 1% on a trade, let's say I like the idea of getting long, as the picture down below, that stop loss is $10 worth of distance. So the amount of profit or the amount of loss that I will incur if price goes down and hits that stop loss will be $10 on the account, which is about 1%. What that means, just from a big picture level, means that if price comes down and stops me out for that 1%, it's not going to kill me. Sure, I don't want to be taking losses, but losses are going to happen anyways, so I don't want them to destroy my account. If getting stopped out really, really hurts you, your stop loss is probably too big. Let me say that again for the people in the back. If getting stopped out really hurts you, if you feel yourself like get hit in the chest and you're like, oh, that really sucks, your stop loss is probably too big on the account. So again, using this simple rule, you hear it all the time, risking 1% to 2% of an account really is a pretty good rule in my opinion. So with that said, that is what I'm saying is it was risking 1%, or if you had $1,000 in an account, that's $10. If you had a $100 account, that's risking $1, which is a little bit tricky because sometimes even a 0.01 lot size, risking $1 on an account becomes tricky. So there is a minimum to trading capital. I'd say you probably want to start with at least $500, maybe $1,000 minimum. I know it's a little bit large for some people in other countries. It definitely depends where you are in the world, but another topic for another day. So why not risk more? So if we want to make more money, why shouldn't we just risk more? What's the downside of risking more than 1% to 2%? Well, let me scare you a little bit because I think we all need to be scared when it comes to trading, because if the market humbles you and scares you, that's a good thing because you won't make a bunch of stupid mistakes that myself and maybe half of the audience listening have made as well. And I don't say that to disrespect anybody because, again, I've made a lot of dumb decisions myself. So we're trying to correct them today in this video. So with that said, why not risk more? Remember, as responsible risk managers, or the ones that we're at least striving to be, we have to account for the bad times in trading. We have to be that negative person, that super paranoid person when it comes to trading at sometimes, because that is a positive kind of trait when it comes to a good trader. But they want to be a little bit concerned with, the negative. Well, this could happen and this could happen. You want to have that idea in your head because there's Murphy's Law, which says if it's possible to happen, eventually it will happen, right? So we have to account for the bad times when it comes to trading. Losing streaks can happen. If you have 10 losses in a row, can your account actually handle that? Ask yourself right now, the current way you are trading, if you took 10 losses in a row, how's that account looking? If you were to risk $100 per trade on a $1,000 account, it could get really ugly really fast. And so that's what I'm trying to do. I'm joking and I'm messing around, but I'm also serious about this because this is a pretty devastating topic for a lot of people. So when I'm saying this, I am serious. I think it's very important not to risk 10% of an account on every single trade, as so many new traders do. That means if you were to risk $100 per trade on a $1,000 account, you're risking 10% per trade, and 2 losses would leave you to a negative 20% drawdown. So you take 2 losses, just 2 losses. I take 2 losses for breakfast sometimes, and that's a 20% drawdown. 5 losses, that's a 50% drawdown. And if 10 losses happen in a row, your trading account is all over. You've lost all of it. And so you might be saying, well, Nick, 10 trades lost in a row, that's never happening. But let me tell you that I took a 10 loss streak sometime in this year, 2020, survived, completely came back. But I took 10 losses in a row during all this craziness in 2020. And fortunately was able to recover that loss and more, profiting the rest of this year so far. It's been pretty good. But if I had 10% risk per trade, I would have blown my entire account. Fortunately, I did not. I was risking only 1% to 2%. That leaves me so much more room for losing streaks, bad trading days, and all that sort of stuff that just happens to all of us. None of us are perfect. None of us are God traders like the ones on, YouTube or some of the fake gurus that are out there on social media that try and make it all look so easy, right? We don't want to be like that, and we know that's not real. If you're this far in the video, you've got a straight head on you, and you're pretty focused on this stuff, because I know this is not the most glamorous or exciting video. So if you're still here, then you know that there's a bunch of fake people out there who try and make trading look like it's easy and it's just a get-rich-quick scheme, and it's just not. We know it by now. Losing streaks happen to every single trader, even the best traders, and so we want to be ready for those. And that means keeping our risk managed by using small risk, not risking giant amounts of the account. Hopefully you get that. 10 losses happens to people. Don't let that destroy your account. Okay, so how do we know what position size to actually use? The lot size on your account, or if you're trading stocks, how many shares do you buy? I'm sure there's an equivalent to what I'm about to talk about here for stocks, but for Forex, one of the easiest ways is to use a lot size calculator, which you can find on websites like babypips.com. I'll link that down below in the description, and if I forget, I shouldn't, but if I do, remind me in the comments, and I will pin a comment with the link to this if you don't know where to get this already. So yeah, this is really easy. You just plug in all your information, and it tells you the calculated lot size for the risk that you are wanting to take on a particular position. So if you want to risk $10 or $20, it'll tell you how much position size, 0.01, 0.02, 0.03, etc., to take on the account based on your parameters. So check that out. Very, very useful tool, especially for people who are just getting into this stuff and trying to actually be responsible with their risk management. So let's talk about this next method, because this is kind of an interesting concept. Continuing off of risk management, when you're developing a strategy, and I hope that all of you guys, if you're not already working with a strategy, that you should be actively developing and working on a strategy to trade, because you have to have a full-blown trading plan and strategy to actually succeed in this. In my view, you have to treat this like a business. Businesses have business plans. Traders have trading plans. It is important to account for the worst case scenario in your trading career, because they will happen to you. The longer you trade, the more likely you are to experience tough times. Every trading strategy involves losing streaks or drawdowns, right? Because we're never going to be 100% correct, which leaves probability in there or possibilities in there for losing streaks, drawdowns, bad times. But when do we know how to actually stop using a strategy? Because this is a tricky topic that I don't know if I've covered this on the channel yet. But a max drawdown is a pretty cool tool for this, because a max drawdown allows us to objectively state when something is working right or not in our strategy. So what I mean by this is that if you hit a max drawdown, let's say you set a certain max drawdown on your account. If I hit 25% down in the account, I'm going to stop trading this strategy and reevaluate things. This allows us to stop while we're ahead, or stop maybe before it gets too bad, right? It allows us to pause a strategy and to reevaluate things. Let's continue on this. I know this is a wordy one, so stay with me, but it's worth it. Oftentimes, traders jump strategy to strategy when the strategy does not perform perfectly. I'm sure you've experienced this. Maybe you've even been like me and done this in the past. They jump strategy to strategy. Oh, this works for a week, and then they change their mind because it has 2 losses in a row or something like that, right? They're looking for that holy grail that never exists in trading. This is unrealistic. Not only unrealistic, it's a losing approach to trading, because if you never can stick to something, it's kind of like getting in like 10 divorces in your life. It just gets worse and worse and worse, and it's depressing and it's tough, and that's just horrible, right? We don't want to do that with our trading. We want to stick to something that we've tested thoroughly and give it a proper trial before we move on to something else if we need to, right? Because sometimes you might just find, oh, this actually works pretty well for me. I'm going to stick to this for the rest of time, or at least until the strategy, doesn't perform well anymore. But when is it time to actually pull the plug when something is not working? This is going to be up to a trader's risk tolerance and the results of their back-tested strategy. If you spend all the time studying a strategy and the performance of it historically, you'll see a max drawdown historically. If you do all the numbers and you work on back testing, you can find some videos on that on YouTube and on my channel as well. Looking for historical drawdowns. Let's say that you saw a 15% max historical drawdown, which would actually be a pretty reasonable low drawdown. A reasonable max drawdown for you to consider in your trading plan would be 25%, just as an example, or my opinion, right? So let's say you see 15% historically, and then suddenly when you're actually trading it in real time, you see a 25% drawdown. Maybe at that point you're like, oh, okay, this is actually out of the ordinary. I need to stop and reevaluate, go test, go do all that sort of stuff to reevaluate my trading strategy. If you normally see drawdowns of 25% historically, a reasonable drawdown might be up to 35 to 40%. So a little bit more lenient there. If you're a little bit more risky or more tolerant of risk, you have to put in the work to test all these concepts. These are the sort of things that winning traders just do. If you're not doing these sort of things, it's much less likely that you're actually going to win in the end. You've got to put in the time, test, practice, all that sort of stuff, and study the risk management of it, because that is, again, very, very important. And these max drawdowns can be a good way to essentially stop the bleeding if your account is dealing with really, really bad drawdowns and it's unlike the rest of your trading performance. So what happens if I actually over leverage? So this is another concept that a lot of traders struggle with, is they get themselves into really leveraged positions and they take a big position without a stop loss, and drawdowns can easily blow accounts on massive positions on an account without a stop loss. And if you take a big position even with a stop loss, it could seriously damage your account, especially if you take trade after trade and you just keep getting stopped out. That can destroy an account because you're using big positions very quickly. By using a small position, we drastically reduce our chances of blowing an account. And typically this is going to go hand in hand with only risking 1 to 2% per trade. That's why it's such a good rule in my view. So that's all I've got today on risk management. Hey, do me a favor. If you made it to the end of the video, please comment your thoughts down below. It did take some time to prepare this presentation. I do this stuff for free on YouTube because I love it. It is something I am absolutely passionate about. I do make money off of YouTube, but it's not, this is like above and beyond in my view from what we usually do. So if this was helpful to you, do me a favor. Please subscribe to the channel, give it a thumbs up down below, and we'll see you back in the next video. Thanks so much.